Let's turn back to the markets now, which may be feeling the pressure over the situation in Washington. Kathy Boyle is president and founder of Chapin Hill Advisors and manages $100 million in money. Thank you for stopping by our Rise Exchange today.
Oh, happy to be here.
So, I'm a little bit confused because last week analysts were saying, Wall Street's really not caring so much about the budget standoff because the market kind of trended higher or was kind of like treading water. And now we have a couple days of triple-digit losses, very high increase on the volatility index. So where do you come down? Are the markets now starting to see that there's a problem here?
I think they are, Andrew. I think we broke a technical support level today at about 1665. So probably heading much lower short term, another 1-2%. But remember, we still haven't really had that much volatility. VIX is at 20 today. Up from 13, so up percentage-wise quite a bit, but nowhere near the 48 it was back in 2011.
Do you believe that the markets are pricing in the possibility of a default, or is this still such a remote concept that's not really being considered?
I think it's starting to ache up. I mean, right now, the new report says that the government runs out of money somewhere between October 22 and November 1. So that may give them enough wiggle room to continue this stupid debate on and push things forward so that there's not really an impending, got to do it. And also all the finger pointing, everybody's sick of it except the politicians. So they're all pointing fingers at one another. But I think that people are worried that we would default for the first time in, I can't remember how many years.
And, I had also heard that, in the past when this has happened, that it becomes a buying opportunity. Because if there's this big sell-off now, there is going to be a rally when this is solved. Is it too early to get in?
You got to be careful about those sorts of things because in 2010, when QE1 stopped, before we knew QE2 was coming, market fell 16%, the S&P. Right. In 2011, QE2 stopped, and it was followed by QE3, so there was a rally. We've become like Pavlov's dog. Everybody's just expecting we're going to have a rally and buying opportunity, hop on. There's only so much manipulation that can happen. Stocks are pricey. They're expensive, and we'll see. Earnings season kicked off today. Alcoa was good, Yum was bad. So we'll have to see by the time we get to the end of the week whether it's more fun with the bottom line numbers or are we really getting top line growth.
Earnings drive the market. That's really the core, the bottom line, the core corporate earnings. And what happens in Washington is sort of on the edges and kind of maybe does day-to-day moves that we kind of see. So far, earnings are a little bit disappointing overall, apparently, and many analysts say that we're not looking at substantial earnings growth here, about 3% on the S&P 500. Is that where you're coming in?
Yeah, estimates right in 3 to 5%, which is low single-digit growth, and the market's already up about 60 weeks without 10% correction. We only had these little 2, 3, 5% corrections, so we could be in for a more substantial drop. PEs are running at 16.5, and that's on future expectations. If expectations get downgraded, the PE goes up, right? Because it's price over earnings.
And then the market is, if it's not already expensive, it then becomes more expensive.
It becomes very pricey. And also, people have gotten spoiled. S&P up 19% for the year, a lot of complacency.
Yeah. There may be some people just taking money off the table here.
It could be, or we could have a real fear run for the money.
I ask this question all the time about earnings. Over the last couple of quarters, we've seen earnings grow because of cost-cutting measures by the companies, not top-line revenue growth. They are not creating jobs. It seems like a somewhat hollow victory. Are you seeing signs of a turnaround here, or we're going to get earnings growth through the usual cost-cutting measures?
There's only so much more you can cut. You can only lay off so many people. You can only get much more efficient. You can only, change the size of your packaging so much. So there's really not a lot more that they can do because they've been going on this cost-cutting binge for quite a while. So we don't see a turnaround and a real pickup. Goldman just downgraded their GDP estimates. So did Bank of America. So a lot of people are coming in on GDP downgrading as well. So, the whole thing fits into a picture. We've been expecting a correction, but we wouldn't know what the catalyst is. Maybe this debt ceiling thing debacle is the catalyst.
Into the fourth quarter, any sectors that you like right now?
Well, we're very defensive. So right now we prefer to have some hedges in there. A lot of the income substitutes.
When you say defensive, walk us through that.
Well, defensive means that we're worried. We think that, if you look at charts, look at home builders, straight up 30% correction from May when everybody started getting worried about interest rate rising. That's what could happen. There's a lot of interest rate sensitive stocks like utilities, drug companies, healthcare, oil. All of those the money is flocked to those. So by being defensive, we want to avoid things that have had these straight up runs and could have fairly significant corrections if you get in here. If you got in a while ago, if you got in on Apple at 85, who cares that it went from 700 to 500? But if you got into Apple at 650, you're hurting. So that's really the issue. So what you want to look at, I do think inflation is present in our economy. economy, and I think it is going to show up. So I personally like gold. The gold miners.
We've seen a big pullback in gold this year.
Big pullback in gold, and Goldman just said it's going to $1,000. So a lot of people laugh that that's what they tell people, but that's not what they're doing. So we'll see if there's a buying opportunity in gold. Gold miners and the gold miners juniors, there's GDXJ and GDX, are both, I think, buys in here. They can go up. And then oil has lagged. Oil and oil service has lagged the big companies.
Okay. Kathy, thank you so much. Kathy Boyle.
Great to be
Appreciate
here.
it. Thank you for stopping by Arise, and hope to have you on again. Coming up, look who is rallying since Obamacare went into effect. The details ahead. You are watching Arise Exchange.